In 1975, one of America's biggest retailers collapsed. For years before that, it kept reporting profits. The numbers weren't fake, they were legal, they were audited, and they were almost useless. So here's the real question. What are financial statements actually for? Because it's not what you think. This isn't trivia. Your retirement account owns stocks. Every stock price leans on these numbers. Every bank loan, every record quarter headline, all of it rests on 3 documents. And when a company hides trouble, it doesn't just burn investors. It burns paychecks, pensions, whole towns, the income statement, the balance sheet, the statement of cash flows. Most people read them like a report card, grades handed down from above, but that's not what they are. They're witnesses. Each one can hide something. Each one struggles to hide something else. And the truth almost never sits inside any single one of them. In the next 10 minutes, you'll learn how to make them testify. Not in theory. By the end, you'll have 3 checks, 30 seconds each. You can run them on any stock you own. Start with the famous one, the income statement. Revenue minus costs equals profit. It answers one question. How did the business do over a period? Sounds like measurement. It's closer to storytelling. Here's why. Say you run a business. In December, you deliver a $100,000 order. The customer will pay in March. Your December income statement proudly says you earned $100,000. Cash actually received, 0. And it cuts the other way too. Pay a year of rent in January, and the expense spreads across 12 months. Money gone today, cost recorded slowly. That's not a loophole, it's the design. It's called accrual accounting. Record the sale when it's earned, not when money arrives. Match every cost to the revenue it helped create. But matching forces judgment calls. How fast does equipment wear out? How many customers will never pay? What will warranties cost next year? Every answer is an estimate, made honestly, checked by auditors, still an estimate. And within the rules, 2 honest accountants can reach 2 different profits. Watch how quiet this is. Your company buys a delivery truck, $50,000. One accountant says it'll last 5 years, so it costs $10,000 a year. Another says 10 years. Now it costs $5,000 a year. Same truck, same road, 2 different profits. And nobody lied. Economist Alfred Rappaport said it plainly. Cash is a fact, profit is an opinion. So the story can bend. Fine, then look somewhere solid. The obvious place is the balance sheet. It looks like bedrock. The balance sheet isn't a story, it's a photograph. One single day, what the company owns, what it owes, and the difference. And it always balances, to the penny. Feels like bedrock, right? First problem, it balances by definition. That's arithmetic, not health. A dying company balances perfectly, all the way to the grave. Second problem, it's one day, and companies know exactly which day the photo gets taken. You do a version of this yourself. You clean the apartment right before guests arrive. The apartment is real. The tidiness is scheduled. In 2008, Lehman Brothers ran a maneuver called Repo 105. Right before the quarter-end photo, roughly $50 billion of assets left its balance sheet. Days later, they came back. The bankruptcy examiner later called it balance sheet manipulation. The photo looked healthier than the patient. And months after that second photo, Lehman was gone. The tidy balance sheet outlived the bank by barely a season. Third problem. Some things in the photo are soft. Goodwill, for example. A number born from a deal price, kept alive by estimates. Quick gut check. When you glance at a stock app, the earnings, the book value, you're reading the story and the photograph. You haven't touched a hard fact yet. So the story can bend. The photo can be staged. What's left? The third witness tracks one thing. Money in, money out. No stories about when a sale counts. No estimates about useful life. Just movement of cash. And here's what makes it different. Cash reconciles with something outside the company. The bank account. You can argue about when revenue is earned. You can't argue with the balance at the bank. That doesn't make it impossible to fake. It makes it the hardest of the 3. Which brings us back to the retailer from the first 10 seconds. W.T. Grant. Grant was a giant. More than 1,000 variety stores across America. And in its final decade, it was expanding hard. New stores, new regions, new shelves to fill. To keep sales climbing, it leaned on one tool above all. Its own store credit. Easy terms. Few questions asked. Now think back to your December order. Every credit sale at Grant worked the same way. Revenue counted on the day of the sale. Cash promised for later. And for too many customers, later never came. So profit piled up on paper, and the cash fell further and further behind. To cover the gap, Grant borrowed. Short-term loans, rolled over again and again, which works right up until the banks say no. In 1975, they said no. The collapse was one of the biggest retail bankruptcies America had ever seen. Tens of thousands of jobs went with it. On paper, Grant kept making money, but from the mid-60s on, its operations bled cash almost every year. Two lines, one held up by accounting choices, one sinking toward zero. Year after year, they pulled apart. Now the uncomfortable part. Almost nobody was watching that red line. Two researchers, Largay and Stickney, rebuilt it by hand from Grant's old filings. They published the autopsy in the Financial Analyst's Journal in 1980, 5 years after the funeral, which raises a fair question. If cash is the closest thing to a fact, why not read only the cash flow statement and ignore the rest? Because that would be a bigger mistake. Because harder to fake isn't impossible. In 2002, WorldCom reclassified about $3.8 billion of everyday network costs. It called them long-term investments. That slid the outflows into a different section of the report and inflated operating cash flow. Weeks later, the company collapsed. Even the fact witness has seams, and the gap cuts both ways. Early Amazon posted losses year after year. Meanwhile, its operating cash flow turned positive and grew. Its first full-year profit only arrived in 2003. The cash told the truth years earlier. A gap between profit and cash isn't a guilty verdict, it's a question. And that's the actual design. Watch one deal hit all three documents. Sell on credit. The income statement books profit today. The cash flow shows nothing yet. The balance sheet quietly grows a pile of IOUs. One event, three shadows. When the shadows disagree, that's the signal. And the signal is measurable. In 1996, accounting researcher Richard Sloan put numbers on it. Firms whose profits ran far ahead of their cash went on to underperform. Trading that single gap earned roughly 10% a year in his sample. The logic is simple. When profit runs ahead of cash, more of it is built from estimates and IOUs. Estimates get revised. IOUs go unpaid. Sooner or later, the story gets marked down to reality. And the market itself keeps under-reading these documents. So this isn't three reports, it's one cross-examination machine. Now for the part that should genuinely bother you. One of the witnesses is a late hire. American companies weren't even required to publish a standardized cash flow statement, not until 1988. Grant collapsed in 75. The autopsy came in 1980. The rule arrived more than a decade after the failure it could have flagged. The fact-checker was bolted on, after the fact, which flips the whole picture. Financial statements were never a report card written for you. They're testimony, prepared by the company, within the rules. In the most flattering light the rules allow. And that's not a scandal, that's the job. The CFO's job is to tell the best true story. Yours is to check it. The truth doesn't live inside any one document. It lives in the gaps between them. So let's make this real. 3 checks, 30 seconds each. No finance degree required. Every public company publishes all 3 documents, every quarter, for free. Check 1. The story. Open the income statement and find net income. Growing? Fine. That's the company's version of events. Write it down. Hold it loosely. Check 2. The fact. Find cash from operations on the cash flow statement. Put it next to net income. They'll never match exactly. They shouldn't. But a big gap that shows up year after year is a flag on the play. Check 3. The photograph. On the balance sheet, look at what's growing fastest. If customer IOUs or unsold inventory grow much faster than sales, the story is running ahead of reality. That's how Grant looked in its final years. 90 seconds, 3 witnesses, 1 cross-examination. Remember the retailer from the first 10 seconds? Its income statement said healthy for years. Its cash flow said dying. Nobody compared them. That's the whole lesson in one line. Never let one witness testify alone. And if you keep only one of the 3 checks, keep the second. Net income against cash from operations. 2 numbers, 1 minute. A gap that never closes isn't proof of guilt. It's your cue to ask why. That habit alone puts you ahead of most of the market. And if you're wondering how far this can go, one company turned every trick in this video into a weapon at the same time. It staged the photo. It bent the story. It even dressed up the cash. And it fooled the rankings, the auditors, and most of Wall Street. For years. That story is next.